participating means that you basically participate in the profits of the company. So when you are a policyholder with a participating mutually held life insurance company, you effectively act as a shareholder of that company. And so therefore, the dividends that you participate in are going to be much higher than if you were to work or have a policy with a non-participating mutually held company. Now, this is really important to understand because there are companies out there like State Farm and I think Allstate, and there's some other companies out there. I don't even know what the list is, but they are mutual companies, but they're not participating mutual companies. So to be able to have a properly designed policy, it needs to be with a participating mutually held company. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, we're going to be talking about what is required to be able to properly design a whole life insurance policy. Now, this is the comment that I got, and a YouTube follower here, some of you, I guess, maybe stumbled across this video. I'm not sure if they're a subscriber or not, but anyway, they had a comment, and in the interest of me doing what I do, I figured I'd try to film a video to respond to it and give a good answer. Now, ultimately, the comment was too long to respond to via text because there was too much to it. It would have been a complete dissertation, so I figured what better way than to film a video to respond. So here we go. So I've done videos, and I will link them in the description below about how to properly design a whole life insurance policy in 2022. I have that video up. That shows different ways that you can ultimately construct a whole life policy. But ultimately what this comment came down to was, okay, Chris, it's all great. I'm really tired of hearing life insurance agents talk about the whole life insurance is great so long as it's properly designed or properly structured. And ultimately, I really am tired of hearing that, and it's confusing. So how do us lay people understand what a properly designed policy looks like, and how do we know if we have one or not, right? And so in this situation, he says that his father-in-law bought his wife a policy 10 years ago, and they called. The agent said they get the whole death benefit, and what the heck does that mean? So I did a video on this past week about why you don't get to keep the cash value and the death benefit. So I will once again link that down below as well, because I don't want to go into depth about some of these topics. I'm going to braze over them, and if you want to do a deeper dive, I'll reference back to that and you can go there. So what I broke down here are ultimately the three things, and it's not this simple, but I wanted to break it down into its simplest parts, right? And really talk about the three pillars, the three fundamental components that you need to be able to have a properly designed policy. And it's really simple. These are things that you can go, you can look at your policy, you can evaluate it, and you can see if you have one or not. And if you don't have all three of these things, chances are your policy is not designed properly, and you may want to have somebody take a look at redoing it for you. And by the way, if you have any policies and you want to have them looked at, you can always go to life180.com, or you can look at the link in the description below. You can set up a call with one of our people, and they can absolutely go through, give you an evaluation, give you an assessment of where your policy is at, what it looks like. If it's properly designed, they can help you, and they will ultimately give you context as to whether you should either 1035 exchange that or cancel it or what have you. They'll let you know what your options are ultimately. And so let's get into this and talk about the three things. So the first thing that you need to have to be able to know that your policy is properly designed, this actually has nothing to do with the design. This has everything to do with the possibilities and the potential of the policy. And what it is that your policy needs to be with a participating mutually held life insurance company. Now, what does that mean? Participating means that you basically participate in the profits of the company. So when you are a policyholder with a participating mutually held life insurance company, you effectively act as a shareholder of that company. And so therefore, the dividends that you participate in are going to be much higher than if you were to work or have a policy with a non-participating mutually held company. Now, this is really important to understand because there are companies out there like State Farm and I think Allstate, and there's some other companies out there. I don't even know what the list is, but they are mutual companies, but they're not participating mutual companies. So to be able to have a properly designed policy, it needs to be with a participating mutually held company. And that leads us to point number 2, right? So point number 2 is basically saying that you need to have a proper blend of paid up additions inside of your policy. Now, this is important to understand because unless you are with a participating mutually held company, this is probably not even going to be an option for you. So that's going to be a good way for you to know if you are in the realm of a contract. This is going to be a contract that's properly designed. If you don't have any paid up additions in your contract, then you know that your policy is not designed properly. So here's how you can tell. If you have no paid up additions, what's going to happen is, let's say you have a $100,000 death benefit, and you start making premiums. Your liquidity on the front end of your cash value is going to be really, really slow. It's not going to be as liquid out of the gate. You're not going to have as much cash access right out of the gate. And the other part is, if you have paid up additions, you have a situation where as the cash value grows, you're going to have more liquidity, and B, as the cash value grows, so does the death benefit. The death benefit will go up with it, right? So the video I did last week was talking about the fact people are always saying, why don't I keep the cash value and the death benefit? Well, I understand why people don't like whole life insurance from that context, because most people don't understand how to design these properly, right? Nobody knows how to design these. That's hard to say for some reason. So or at least right now it is. And so when you look at how most people do this, you'd have a $100,000 death benefit. You'd have very little liquidity of your money. And then as you started gaining liquidity, the death benefit doesn't go up. That's a poorly designed policy. And so in that process, you don't get to keep the cash value and the $100,000. You only get to keep the $100,000. Now, I will say that the net amount at risk for the company is shrinking. And so that long-term cost of insurance is kind of baked into that. And so it's not all as bad as they make it out to be. But what I will also say is that it's not optimized, right? And so to optimize, we got to be focused on cash liquidity and cash growth. And in order to have that cash growth, you need to have the paid up additions that will bump the death benefit up as well as the cash grows. So while you only keep the death benefit, and that's absolutely true, if the cash is going up and then the death benefit is going up accordingly, that $100,000 that you had in death benefit to start will be above and beyond whatever cash value you have. And so then you're only reaping the tax benefits rather than having this pile of money that you have in cash value sitting in a bank account and having to pay taxes on that for inheritance as time goes on. So making sure that you have these paid up additions is key. Now, how do you know what blend to use? Because when you leverage paid up additions, there's an infinite possibility of blend. And you'll see a lot of people on the internet that talk about you need a 10-90 policy, which is basically saying you need to have 10% base, 90% paid up additions, and that's going to give you the most liquidity, and so on and so forth. And they make that out to be that it's this big, great, amazing thing, and that's the only way to design a policy. I'm going to tell you that nothing could be further from the truth. The best policy is the one that helps you meet your objectives based on what your financial situation is, how you currently have your finances designed, where you currently have your capital stored, how much liquidity, how much money that you have, whether in all these different accounts, how you have to move money around to make your life more efficient, so to speak. I couldn't think of a clever way to say that, I suppose, but how to make your life more efficient by moving money around and utilizing a properly designed whole life insurance policy as the foundation of your financial life. Depending on how your financial construct currently is as you're going into the policy, you may not be able to do a 1090 policy. It may not be an option based on how you fund the policy. And so it's really important to understand that. And so I'm a big believer, anybody that tells you there's only one way to do anything, I would avoid them like the plague personally. And I would say anybody that says there's only one way to do anything doesn't really understand the principles behind how these things really work and how they can help you solve the problems that you have in your life. Because I'm a big believer, that life insurance, whole life insurance, even when properly designed, is just a tool. It's not the end all be all savior that's going to solve all your problems, right? It's just not. And so it can be an amazing tool that you can leverage if you understand the principles and how to leverage it to accomplish your goals, right? But if you have to work with somebody that understands that. So that's the other thing I would say. Now, how do you know, I guess, in order to get more PUAs into the policy, what you have to do is, number 3, you have to attach a term rider to the policy. Because otherwise, if you don't have a term rider on the policy, a term insurance rider, what that's doing is, let's say you have a $100,000 face amount for your whole life policy, and then you do a lot of paid up additions. What's going to happen is it's going to become a modified endowment contract. And when it becomes a modified endowment contract, you lose all the tax benefits while you're alive to access your cash value, which is obviously flies in the face of the whole concept of infinite banking and utilizing whole life insurance for the living benefits that you're looking to use, right? And so what you need to do is you need to make sure that you have a term insurance rider attached to the policy. And when you do that, that will give you more death benefit that allows you to put more paid up additions into the policy to be able to make sure that it doesn't become a modified endowment contract and you keep all the tax benefits. So in summary, this is really simple. All you have to do is make sure you're with a mutually held life insurance company, a participating mutually held life insurance company. You want to make sure that you have a blend of paid up additions. And once again, that blend can be anywhere from a 50-50 blend to a 10-90 blend. It just depends on your current construct. And then third, you need to make sure you have a term rider on there to make sure that you avoid it becoming a modified endowment contract. If you have all 3 of those things, then you can rest assured that you are much closer or have a much higher likelihood that your policy is properly designed. Once again, if you have any questions, go ahead in the link below, set up a time with one of our Life 180 coaches, and they can help you out. They can help you give an evaluation of your policy. And as always, if you have any comments, any concerns, anything you don't want to talk to anybody, you just comment in the comment section below. I'll do my best to engage with every single comment that I see. And that's it. If you haven't already, make sure you subscribe, hit the bell. That way you get notified every time I launch a new video. And I'm launching all these new shorts. You can find me at Real Chris Kirkpatrick on TikTok, on Instagram, on Facebook. Go check me out. Hit me up, friend me, like me, all of these different places. I look forward to connecting with all of you. I'm trying to do more short content on all these other platforms to reach you on your favorite short content consuming platform in the world. So whatever one you prefer out of any of those, and we'll go from there. So anyway, hope you have a blessed, inspirational day. We'll see you on the next video. Take care.